All right, 1 second. I'll be back 1 second. It has to close, and then I'll be back. 1 second.
Okay.
Can you hear me?
Yeah.
Okay, bet. Okay. Okay. So we'll actually go back to like, oops. We'll go back to like the main basics.
Okay. Also, yeah. Yeah. I had like the very basics. Like, are you looking at this on your computer or your phone?
I'm sharing my computer screen to you in the Discord. You'll be able to. Are you able to see it? So if you open
Okay.
up the Discord app, go to the Discord, and then we'll be able to open up my screen recording.
Okay. I see it.
Okay, awesome. So we'll go back to like the main basics, like before you should even really start trying to swing trade or trade in general. You just have to understand like we'll go to the complete basics, and so we'll just figure out like how do we find good stocks to invest in. Like what is a good company? How do we know if it's a good company? These are all questions that we can figure out by just doing a little bit of research ourselves. And then that way, there's a few things you can do that might take, let's say 10 minutes, and you can figure out whether or not it's a good opportunity to buy or sell that stock, or wait for an entry. You'll figure out whether or not you should buy. So we'll look at Facebook for an example, and I use Yahoo Finance, and so we'll go to Yahoo Finance, and we'll just get a bunch of information, and so starting with the basics, we're just going to look at what does all of this mean. And so when we have Facebook, we obviously have FB, which is the symbol that you type into the stock market. That's referred to the ticker symbol. When you look
Mhm.
at something like Apple, AAPL, that's Apple. So that's basics. And then when we look at what this stuff means, what does this mean? Well, the market cap is $811 billion. That's referring to how much money total is in this company. So um,
Okay. Yeah.
that's just like the overall combined with all the investors and all the shareholders, all the shares added up, multiplied by the share price, you'll get the market cap. And then so some of this other stuff, 52-week range. So the 52-week low, the 52-week high. Um, so what that's referring to is the range that the price has gone. If we go to the yearly chart, we could see in the year the lowest that it got, was $137, which was around here in March. And then the 52-week high is $304 when, the stock price up here in August got to 304. So ideally, what are those numbers telling us? Well, the numbers are telling us that a perfect, yearly trade, yearly entry would have been, down here, and then you would have sold here, and then, you could have bought more here, and you'd be up. So that's just like in general, like that's if you were to invest perfectly. The reason why these numbers are significant is because for a good company like Facebook, or if we take Apple, for example, ideally you want to invest as close to that 52-week low as possible if this is your long-term investment, right? If I'm going to, Facebook and Apple, which are good companies, which I'll show you through the financials why they're good companies. um, Ideally, it makes sense, right? You want to get to that 52-week low versus that 52-week high. Right now, it's obviously really far from that 52-week low. So if you're thinking about potentially investing in Facebook long term, there's some other things that we'll look at to figure out if we should buy right now. But aside from that, that's really all that you need to pay attention to. The other thing that I pay attention to is the PE ratio, and so that's essentially how much is Facebook trading above their profit earnings, and so the profit earnings is like how much they earn per share, right? So how much is Facebook earning in revenue? Uh, and then, so what that number means is Facebook is the market cap of Facebook, the value of Facebook. It's trading 32 times its yearly revenue, which in theory really isn't that outrageous, right? Um, that's saying that Facebook, essentially this is saying that Facebook is worth 32 times 800 billion, which once we get to that, we're talking about, $25 trillion is the overall value of Facebook if you were to buy it, which is obviously like an insane number to think about, but isn't necessarily unrealistic in terms of things because Facebook is obviously a huge company, but the market cap, that's what it is. So it's trading, essentially 32 times its revenue. When we look at Apple, it's the same thing. It's trading 34 times its profit earnings. So that's something you need to look at. When it comes to like something like Tesla, you'll see the difference, and that's also why Tesla stock is more volatile, because we're looking at a profit earnings of 838, right? So that's obviously a lot higher. But then going to the next step you would take is then to look at the statistics. Okay, so what you want to see is, a good profit margin, meaning that of all the money that goes into Facebook, 32% of that is profit. The operating margin, that's how much of their revenue they have to spend to stay operating. If we look at something like Apple, we'll see Apple's profit is 20.9 and their operating margin is 24%. So they only spend 24% of their money, of the total revenue. And then return on assets, 13%. That's good. We compare it to Apple, we see 12%. So that's what we expect for a company with, a big established company that's making good money, that's a popular brand. Apple, Facebook, we'd like to see these type of numbers. Return on equity, 73%. Right here we see return on equity, 23%. So that's like the return on their own money, and so or return on equity, I'm pretty sure. So equity is the value of the shares. Yeah. So Apple, like these companies can own their own shares to an extent, and so like that's the return they've gotten on their own share because Apple is up that much percent this year, essentially, at the time of this recording. That's not as important as I'd say return on assets. That's more important. I could be wrong about this return on equity too. I'm not 100% sure. So now this is what really matters, is the income statement. And so there's a couple things you want to look at. Their total revenue, okay, so $274 billion, which is a lot, right? That's why Apple has a market cap of 1.8 trillion. So that 275 billion is it's not like this 1.8 trillion is too exaggerated, right? Like it's a pretty fair value for the company in today's terms of the market. Quarterly revenue growth, we'd like to see higher than 1%. If we go to Facebook, you could see their quarterly revenue growth was 21%. So that's a lot more attractive to me as an investor, as I'm just looking at certain things. Like, obviously you want a company that's growing quarter over quarter, year over year. That's what the YOY means, year over year. I'll also, we'll have a calculator out just to do some simple calculations. We have a total revenue of 78. We're looking at Facebook, $78 billion for Facebook. Their quarterly revenue growth 21%. Their gross profit 57 billion. Their net income 25 billion. Their quarterly earnings growth was 28%. So revenue growth 21%. That's a good increase. Earnings, which is even better, that's 28%. Earnings meaning like earnings per share. That's a lot better. When we look at, and then we'll just do some basic calculations. We'll take the net income divided by the total revenue. So we have 25.28 divided by 78.98. So this is just some simple calculations you can do yourself, just to get a general ballpark. We'll turn it into a percentage. Facebook is netting about 32% of their total income. Of the total money that goes in, its net income is 32%. That's actually fairly good, right? That's really good. So we'll keep that in mind, that 32, and then we'll go to Apple. We'll do the same thing. Apple, total revenue of 274. Their quarterly growth was only 1%. Their gross profit was 105 billion. Their net income was 57 billion, and their quarterly earnings growth was negative 7%. So obviously, again, that's worse, right? Like, Apple's still a good company to invest in. It obviously got impacted by the coronavirus, but Facebook, a company that's all online and that makes its money online, isn't necessarily harmed by the coronavirus. It's actually benefited, and that's why you're seeing a 28% increase. So when you're just comparing apples to apples, should I invest in Apple or Facebook? Facebook is obviously right now, just based off of our quick analysis, is already looking more attractive. Okay, and then we'll just do the same type of math. We have 57.41 is their net income divided by their total. Keep in mind the last one was 32 or 34, and then we'll divide by 274. So then we can see here times 100, this is 20.9, and that's the same number that we get here, right? The profit margin, right? So we're just calculating the profit margin, but that gives you, that explains how the profit margin is so significant. A company like Facebook is securing, a 12% more profit margin. So that's why if I was investing in either of the companies, Facebook has a lower profit earnings, right? This is 33, this is 29, and they're trailing. So in theory, Facebook is trading at less inflation and it's getting more revenue. So if I were to say Facebook or Apple, both are good, but Facebook is the winner here when you look at the balance sheets and you look at the statistics. The last thing that we're going to look at is this balance sheet, and we look at the debt versus the cash. So we can see here total cash 55.6 billion, and their total debt is only 11 billion. This goes along the whole idea again. Facebook, because it's an all online company, it doesn't cost a lot of money to run it, to start it. So they only have to take out $11 billion of debt to this date, and they have way more cash. Okay, and so when we look at the ratio, it's 5.5, the current ratio. You want to see obviously a high number. You want more cash and less debt. When we compare it to Apple, total cash 90 billion, total debt 122 billion. So their current ratio is 1.36, but don't get fooled here, it's a negative ratio. So it's better to do this calculation yourself. 90 divided by 122, and you get 0.73. So anything under 1, when you do your own calculation, anything under 1.0 is bad, right? You don't want to have more debt than cash. So again, Facebook wins in this department. Okay, so the last one we'll compare is Amazon stock. Okay, and then once you get the hang of it, all you have to do is then compare companies that are that are similar to each other, right? So if we want to compare other companies, like let's say we're looking at
Google.
yeah, like we could look at Google, but these companies, Google's actually up a lot. These companies, Google's actually really killing it, but these companies are all in the same sector, right? They're called the FANG: Facebook, Amazon, Apple, Netflix, Google, like the big tech stocks. These
Mm-hmm.
That's like what their categories. So you have to make sure you're comparing apples to apples. Okay, you can't compare you can't compare the you can't do the same statistic where you're getting like the PE ratio of 33. Like let's say if we're comparing like Ford, like it's not going to be the same. It's not going to be you can't it has to be apples to apples. You can't compare a car company to a tech company because car companies are going to trade at complete different earnings ratios and things like that, because of let's say it's just a different sector, so it's not going to be the same. However, this is interesting, right? Because we're looking at Ford, we see that um, Ford is valued at $144 billion, and their market cap is only 30 billion. When we look at something like Amazon, you know, this is what Yahoo values at 1.5, and the current market cap is 1.5. So it's the valuation that Facebook's giving it. But when we look at these companies that are beat up um, by the Rona, like American Airlines, we'll see what. So you have to make sure. So if I'm going to compare airline stocks,
Wait,
I,
what?
if I'm going to compare airline stocks, I want to compare airline stocks to airline stocks. That's the whole idea. I'm not comparing American Airlines to Apple or Facebook. I'm going to compare American Airlines to Southwest Airlines to determine which one is better and which one would be a better investment. Does that make sense?
Mm-hmm.
Okay. Um,
But right now we're still talking long term, right?
yeah, I mean this is long-term investing. Yes, as well as just companies that you want to trade. I mean, when we're day trading, we want to make sure we're still day trading a good company, right? We don't want to be day trading a shit company. So even when you're even no matter what you're doing, if you're looking to either trade a stock or invest in a stock, you want to make sure that you are um, that you're um, making sure that you're doing a good company. You don't want to be trading a shit company, essentially. So yes, this applies to long-term investing and just investing in general. Like when you look at something like American Airlines that got beat up so much, American Airlines, I wouldn't trade American Airlines. It's not going to have the volume that you want. It's not going to have it's not going to have, the fluctuations that you want. Something that's traded frequently, popularly traded, like Facebook, like Apple, like Tesla. These are better companies to day trade, to swing trade. Um, but if I'm looking at long term investing, Ford is not a bad company to invest in because, um, like, here's the reason why the stock is so beat up because of the coronavirus. I mean, their quarterly revenue growth got negative 50% decrease. Their net income, they lost $2 billion. Um, but when we look at their quarterly earnings growth, I mean, I don't know if that number is real. That could be fake. I mean, sometimes I mean, that's a really high number. So I don't know if that's even true, but I guess we could look it up, Robin. Let's see what Ford did. Okay, so when we look at Q3 of 2019, and we look at Q3 of 2020, they did actually beat their Q3 to their Q3. And here's the thing too, why Ford is also looking like not too bad of an investment, because we're obviously it's doubled since that 52-week low, but Ford is changing, right? They're it's always going to be America's vehicle. It's always going to be the government vehicle, and also they're changing to now build electric cars. They're completely changing, and so they're obviously not gonna just go away. So something like this doesn't look like a bad investment. Another one that I like is GM, General Motors. I mean, they're doing some good stuff too. So these are things just to keep in mind. Some of these companies that are really beat up from the Rona aren't looking too bad, um, as some long-term investments, right? The best airlines I'd recommend is Southwest Airlines, because when you compare the financials, they're looking a lot better. Total cash 14, total debt 12. When you look at American Airlines, it's not gonna have a positive ratio. Most I'm thinking. So yeah, look, total cash 8 billion, total debt 40 billion. So you have to compare apples to apples, but you can see why American Airlines is not the company to invest in. Southwest Airlines is the airlines to invest in. So if you're comparing cruise stocks, right, like Royal Caribbean, you want to compare Royal Caribbean to the other cruise line stocks. Some of the other ones might be like Norwegian Cruise Line, Carnival Cruise Line. Like we could just do these real quick. Spelled it wrong. Let's see. Okay, so we'll look at the statistics here. 4 billion cash, 19 billion debt, so that's not too good. Let's compare it to Carnival.
Wait, it keeps flashing on and off. Are you seeing this?
What is?
The screen was.
Oh, my screen? You can't see my screen? Can you see it now?
Yeah.
Okay, sorry. Just let me know if that happens. Again. You can see this Carnival Cruise Line?
Yeah.
Okay.
I see it.
Okay, so we'll compare it here. 8 billion cash, 26 billion debt. So it's still kind of that same ratio, 1 to 4. So then you could look at their revenue. You can see how they got crushed. I mean, nobody went on cruises, right? Negative 99% revenue. So that's why these stocks are so beat up, right? The value is obviously more, but because of the Rona, it really crushed these companies. So these are companies that really aren't too bad. I would kind of recommend Southwest, potentially Ford Motors. Another one that I like is Fiat Chrysler, which is Fiat, Chrysler, Jeep, Dodge, Ram, Maserati. They also own Ferrari. And these companies are all changing to become to change to be electric vehicle stocks. So this is actually a company that I bought. I bought Fiat Chrysler around $9, and I'm up 40%, right? And that's great, and so these are good companies to invest in and hold because they're doing really well. They're coming back, and so this is what you want to see also is this confirms that the bottom was in. What do you see here? You see a W reversal, and this W shape is a positive reversal. Why? Because we have a low, we have a high, we have a higher low, and a higher high. That's what essentially started this trend back up. When we look here, we had a low, we had our low, and then our lower high, our low, our lower high, our low. But that's why it continued to trend down. When another pandemic hits, another stock market crisis hits, which will in probably another 10 years, how are you going to prepare yourself for the next one? Well, you want to prepare yourself by making sure you wait for this positive W shape So even if I waited for it to complete up here at $8.35, I could see here that this was a positive reversal. And even if I bought here at $8.30, I'd still be up a lot. I'm not going to get fooled on these fake outs, okay? The same thing, but here's the difference now. When you look at American Airlines stock, you'll see it's not a positive um, reversal. You'll see it's a negative reversal. Look what happened with American Airlines. They had a low, they had a high, they had a lower low. Their W reversal when the market reversed was negative, which is why you have not seen a recovery, right? So that's the difference in the shape you have to see as well. Google stock, we look at the year, we see a positive W reversal. That's why it's shot up 64, 65%. Whereas American Airlines, has given you a little bit. If you really got that bottom, it's got you like, 10, 20%, which isn't bad, right? But this has the chance to go to zero. This company could potentially go out of business. You see the same things with the movie theaters. When you look at like AMC stock, you see the same thing. Why did this company go down? Well, they also had a negative W reversal. So that's why it hasn't performed well. This has actually gone down, okay? So this is what you have to keep in mind. The company's chart that looks like this is not a good company to invest in. And if you looked into their financials, I'm sure you would see why it's not a good company to invest in. The same thing that we did with American Airlines, as we could see why American Airlines was not a good investment. So those are the things that you necessarily need to look at before you invest in any company. You need to look at their financials. You need to just do a little of your own due diligence and research yourself before you choose to invest. But how do you feel? Does that clear up a lot of stuff? Does that?
It does, yeah.
I don't want to we could set up another session as well in the future, like in the next couple of days, or through group live stream. I don't want to give you too much today, but is there anything else you wanted to go over, like for the next maybe 10-15 minutes? We could go over something else, or how are you feeling?
I feel good about it actually, because I've been keeping up a little bit with like the past little videos and stuff, and so I was able to keep up with this one too.
Definitely.
And it was like new stuff, so shouts out. But
Cool. Here, the last thing I'll give you then is we'll take a look at this. Okay, so here's to kind of finish it up now. So how do we know when it's a good time to invest in a company? What are we looking for in the chart? This is basic that you can look at. And it has everything to do with the moving averages, like we've been talking about. And so I'm looking at the minute chart. This is like day
but
trading.
your screen is doing the same thing again.
Okay. Can you see my screen? Okay. So if we go, when we're looking to invest long-term or swing trading, we want to look at the day chart, not the minute chart, not to get confused with the minute chart. The minute chart, the 5-minute chart, that's for more day trading. We're looking at the daily chart, maybe the hourly chart if you're swing trading. But if you're just looking to, swing trade, like hold for a week and sell or more, like not within 1 week, but hold a trade longer than a week, you want to look at the daily and the weekly charts. Obviously, because that's what you're doing. You're looking at a bigger time frame. So here's what we've noticed. When we look at the minute chart, we're looking at the purple line. We see that no matter what time of the day it is, the stock price is always interacting with that moving average, right? Going below it, going above it, going below it. Well, that makes sense, right? Because to get an average, you have to have numbers below and above to get an average. But in general, that average follows, the share price, right? And so when it comes to like the daily, and then we look at the moving average, the 20-day moving average with the daily, we have to see, this takes a few days to occur. We have to keep in mind, this is from all the way down here, July 29th, we could see Facebook stock was down to 226, 227, $28, and we could see it was clearly below this purple line. Okay, so what happens anytime that we go below the purple line, we then go above that purple line. That's what you see here. I mean, from 225 to 300, that's more than a 33% gain almost, or more than that. So that's almost a 50% gain, 40% gain. You would obviously sell here. Why would you sell here? Because anytime you're way above that moving average, it's going to come crash back down below that moving average. Now this is your next good time to invest, right? So if I'm looking at Facebook now, what can I notice? Well, we're above that moving average. The time to buy was actually, 2 days ago, because today is the 4th, and 2 days ago on the 2nd, where were we? We were below that moving average. Now what happens? We're above that moving average, and that right there is 250 to 280. That's like a $30. 30 divided by that's 11-12% gain in just a couple days. So that's a pretty good swing trade, right? So those are the things that we have to keep in mind. When should I invest? Well, I want to invest on the daily, at least when it's below that moving average, and then sell it when it's above. Another indicator that we can use is the VWAP. Let's see, it's not really. Let's see. So the VWAP, this chart's kind of fucked up, so I'm not going to go into that on this. We can go into that another thing, but the moving average is the basics, because it makes sense. If you buy stock for 300, Facebook stock for 300, but you can see that moving average is down here at 270, well, what's going to happen? You're buying for 300 when the average price that most people have is 271, so of course you're going to lose money. Well, what happens? It actually went below that moving average, and then now it's sprung back up. So that's why even if you bought, way up here and held, the positive thing is because you're choosing a good company. Facebook, we did all those financials. That's why it's still trending up in general. So even if you make the mistake of doing this, if you hold long term and it's a good company like Facebook with good financials, you're going to be okay in the long run. A year from now, 2 years from now, you'll be fine. But obviously, there's no reason to pay 300 when you could pay 250 if you just waited, or 240 if you just waited a couple days. So that's the whole point. That's what we want to look at. No matter what stock we go to, it's going to be the same thing. With Apple, Apple is actually below its moving average, and so Apple isn't, would be the better buy of the two, even though the financials, but I'm talking about swing trading. Swing trading right now, obviously this is too close. You'd want to be purchasing more down here. This is already too close to that line, but you could flip it for, a few
dollars. How much was it there? How much was it on Apple?
Apple is $113, but the 20-day moving average is 115.97. But keep in mind, as it's a moving average, so as the stock gets purchased below that moving average, right? See, we're at $100 here. The moving average was way up here at 120. Then that drags the moving average down, because now people are paying 100 when before the average was 120. Well, obviously that's going to bring the moving average down, and that's what it did. So it is a moving average. So just because you take a look at the moving average today does not mean that it's going to be the same thing tomorrow. It might be similar, but it's not going to be the same thing. So that's what you also want to keep in mind, is those moving averages. And then also, chart support and resistance levels. So like here on Apple, I can clearly see there's support here at $100. There's some support here at 105, 107. Whereas the resistance, well, there's some resistance here at 120, resistance here at 125, resistance here at 130, clearly resistance here at 137, which also means there's resistance at 140. So these are just, key numbers. Your support and your resistance levels are going to be key numbers. So when it comes to Apple, it's $100, 110, 115, 120. All the big tens are going to be resistance and supports, as you goes down and create support levels. So if Apple were to break through the 140, the next big test would be 150 before it could go to 200 or 150 or higher. But those are also things to keep in mind. If I'm purchasing stock, here at 113, I know that 120 is going to get tested. So I could just plan a swing trade for $5 a share on Apple, knowing that 120 is either going to get tested, and if 120 does not get tested, and then you have your stop loss like right here at $107, because you know that if you lose support here at $107, the next fall is right here, 102, 103. I'm just looking at the bottom of the candlesticks to see, the farthest it went down before it got rejected and bounced back up, and then the highest it got before it got rejected and went back down. That's resistance, that's support. So hopefully that also makes sense. Do you have any comments or?
I was still looking at it, but
okay, I'll go back to it. So just so that you can put that, like, how do I find resistance and support my own self?
Okay, yeah, no, I get that. I get the resistance.
Yeah.
Support.
Is there any other questions?
No, there isn't. No.
Okay, for sure. Well, I'm gonna